One final important topic on equity is the concept of earnings per share. The EPS number is a very widely followed measure of financial performance. You buy one share for $100. Great. The easiest way to understand the accounting performance of that share is to look at the earnings per share number. In effect, if the EPS is 5, then for the $100 that you paid, you made an implicit 5% return on your investment. So the EPS number is the easiest way to judge the accounting success of an investment. From this perspective, the EPS number is very much followed by investors, by the financial media, and a lot of care is put by management to make sure that every quarter the EPS number is just right. We have two types of EPS numbers: basic EPS and diluted EPS. Basic EPS is net income divided by total shares outstanding. The diluted EPS also factors in potential share dilutions because of outstanding share-based contracts. The easiest way to understand is to make an example. Assume a company has the following information about earnings, shares, and potential dilutions. They have preferred stock, warrants, convertible debt. Given this information, take a few minutes to calculate both the basic EPS and diluted EPS. Think and solve. First, the basic EPS. You need to remember that the EPS number is for common shareholders. Hence, if there are dividend payouts to preferred shareholders, these reduce the pot available for the common shareholders. In this case, we have $45,000 a year that goes as dividends to preferred shareholders. We need to deduct that. The remainder we divide by total shares outstanding to get $1.87 of basic EPS. The diluted EPS needs a bit more calculations. The potential dilutions are that warrants can be converted to shares. We have to adjust for that, and we need to increase the total number of shares. Next, if the convertible preferred stock is converted to common shares, then we do not have to pay dividends anymore. So cash available to shareholders increases by $45,000. Finally, our banker, who we had agreed convertible debt with, decides to convert their debt to equity. First, we do not have to pay them interest anymore. The interest is $60,000. But given that it gets a 15% tax deduction as an expense, our net outflow is $51,000. Now our income increases by $51,000. Add all the pieces together, our diluted EPS is $1.73. As you see, it is lower than the basic EPS of 1.87. This is normally the case in most circumstances. When you factor in potential dilutions, the diluted EPS is less than the basic EPS. I give some examples on equity, and I choose some of the more unusual cases. Look at HP. They have no preferred stock and have common stock issued at 1 cent of par. The rest is in paid-in capital of $963 million. As you notice, the common stock number is way smaller than the paid-in capital. Since, as expected, the par value of the common stock is put at 1 cent. All you need to know is that the total common stock, including paid-in capital, is 963 plus 13, which is 976 million. They have no retained earnings. Instead, they have an accumulated deficit, meaning they have accumulated negative retained earnings at minus 1961 million. They also have other accumulated comprehensive losses, bringing our total equity at minus 2228. Why would a great company like HP have negative equity? Well, as you see, even if net income for the year is 2,844 million, and it was also positive last year with 3,152 million, we still are getting negative equity. The secret is in dividends. Each time we pay dividends, we reduce retained earnings. If we pay out a lot of dividends, then the retained earnings becomes negative. And in this case, it is an accumulated deficit. HP is very successful in terms of positive income and positive comprehensive income. But they choose to make equity negative. They do not care. Negative equity means that liabilities are more than their assets. That is okay. For a successful company like HP, with a stable positive stream of income, having more debt than assets is not a bad thing at all. HP is not the only one. There are many companies like this. I put McDonald's next to it. As you see, net income per year at McDonald's is 4,730 million. But shareholder equity is again negative. We have tons of examples like these. If equity is negative, there are three distinct possibilities. Either the company is very successful, B, the company is very unsuccessful and has a lot of debt, C, the company is young, is a startup, and the future is very bright, but at the moment they are not generating positive income.